More than $600 million worth of crypto was stolen.
What could be a record high.
Hackers are draining many accounts.
$600 million.
The biggest ever theft of digital currency.
I can't stress enough how important it is to secure your crypto investments. There's always going to be looting and ransacking, and DeFi is just the new Wild West. Some stablecoins like Tether have administrators that can help track down lost coins, but the vast majority of decentralized currencies do not have these features. If your Ethereum, Litecoin, or Cardano ever get lost to malicious hackers, it can be very difficult to recover those funds unless the hackers just somehow are convinced to give your money back, which has happened more than once. But don't worry, I will offer solutions in this video to keep you protected.
Oh my goodness, what's the procedure?
But first, let's briefly talk about a few incidents that have happened in the past to help highlight the importance of safety here. This is very, very important. One of the first major events happened in 2014 in a controversial story surrounding the biggest Bitcoin exchange at the time, Mt. Gox. This happened at a time when enthusiasm for decentralized money saw many companies like Mt. Gox throw caution to the wind, focusing on the novelty of their projects instead of building a secure system. The tragedy of this story is the fact that in 2013, Bitcoin prices were soaring over $1,200, all the way up from $20 at the beginning of that year. And because of this, Bitcoin had a big red target on its back, and Mt. Gox was the biggest honeypot of them all, handling 80% of all Bitcoin transactions globally. The exchange was exploited, losing $460 million in Bitcoin, an amount that would be worth around $25 billion today. And you might be hopeful, thinking that exploits like these are a thing of the past, because of new security protocols and regulations. And Satoshi works hard. But unfortunately, scammers work harder. In August of 2021, another massive breach hit Poly Network, a protocol that allows users to move their assets between blockchains. The hacker made off with more than $600 million worth of crypto from the Binance Smart Chain, Ethereum, and Polygon's networks. Holders of the lost funds were at the mercy of the hacker, who surprisingly later returned all of the funds. And then, of course, we still have rug pull scams and pig butchery scams being run by the Chinese mafia. We're practically surrounded by bad actors at this point. So this is very important to understand the safety. And today I want to help you go the extra mile with how to treat your crypto investments in a very safe manner. And luckily for us, we have options. Options that will allow us to keep our coins in storage, tucked away and quietly appreciating in value. But they're not all the same. I want to help you choose a diversified set of storage options that best suits your needs. But before I get into my top picks, let's take a minute to define some terms that you absolutely need to know. The first thing that we need to discuss is crypto wallets. These devices, sometimes hardware, sometimes software, keep your keys safe, especially your private key, which only you, as the holder of your assets, should know. You shouldn't tell anyone, don't tell your friend, don't tell your cat. No one. Crypto wallets don't physically contain your digital currencies like a normal wallet would hold dollars or coins or condom or dollars. They basically work like an ultra-secure enclave that stores sensitive information, giving you access to use, move, invest, or transact the crypto that you own. This works through the complex world of cryptography, but for the sake of this video, there are three things that we should first define. And the first on that list is your wallet address. Think of this like the account number of your bank account. Your address doesn't necessarily have to be kept secret, but it could be a personal preference to keep that address secret. Now, some people tend to confuse your Bitcoin address with your public key, but these two are not exactly the same, though they are related. Your wallet address is a hashed 160-bit version of your 256-bit public key. So your address is a kind of shorthand for your public key. Some wallets like Coinbase even hide these numbers completely and instead let you trade with usernames. Now, your private key or secret key is what you want to keep protected at all costs. This is the alphanumeric string that is created when you want to make your crypto wallet. It's technically possible for you or AI to derive a public key from a private key, but the reverse of the process is virtually impossible. It would take the most powerful supercomputer on Earth 650 million years to derive a single private key. So it's pretty safe. But human error is not safe. Also, if you ever suspect that the private key to your wallet is compromised, the best thing you can do is to simply get a new wallet. But we can prevent this from happening in the first place if we take a couple precautions. So let's look at the options for safe crypto storage. What all of these services provide is a way for you to have at least both a public and private key. This way you have full control over what happens with your assets. A public and private key can together work just like any other crypto wallet, even without a hashed wallet address or registered username on a website. The most safe option is to generate a paper wallet, which is a form of cold storage. This is safe, but it does have some drawbacks that we need to discuss. Getting a paper wallet is as straightforward as getting a public and private key randomly generated from an online generator. Once you have both keys, you can send as much crypto to that public address as you wish, effectively putting that money in your private wallet. You can then print or write down your set of keys on any old scrap paper that you like, or you can pretend like you're in a movie and etch them into a gold coin and give that to your wife. But the most safe method is to actually write it down on a piece of paper, laminate that paper, and then keep that in a safe deposit box at your bank. It might be a bit overkill, but that's the safest way possible. This is the best solution if you either have a massive stash of crypto or if you have a chunk that you just simply don't plan on selling anytime soon. A few services that will generate these keys are walletgenerator.net, BitAddress, and Smart Hold'em. Now, as I've implied, paper wallets are actually a small part of the broader category of cold storage options. Cold here means that the hardware in which you store your crypto keys is not connected to the internet. However, keeping your crypto in a cold wallet means that you can't always access the coins that you own if you're trying to spend them, stake them, or lend them. Another option here is hardware cold wallets. And luckily for you, I've tested a few for this video. So let's discuss the criteria that you should look out for, starting with security certifications. Many of the most popular wallets come with an evaluation assurance level rating, or EAL for short. It's a grade that's assigned to the hardware or systems as a measure of overall security. Basically, the higher the EAL, the more reliable the system is to prevent breaches. For more context, this certification is also used by smartphone makers and in the production of e-passports. Ideally, you want the hardware wallet with the best level of demonstrable security, and the Apollo hardware wallets are a good place to start. They've been given an EAL rating of 6+ out of 7. Most other wallets get a rating of anywhere between 1 and 5. The popular brand Ledger notably has an EAL of 5+, which isn't bad by any means. And if you own one, you're probably benefiting from some other features that they offer that Apollo might not have. Arguably, the Ledger is also a bit more user-friendly as well. Ledger also offers holders access to the Ledger Live platform. On Ledger Live, you're able to manage assets stored in your Ledger Nano S or X, which includes buying more crypto, sending and receiving crypto to different wallet addresses, or you can even do certain things like earning interest staking Cardano while keeping it safe in your ledger. If you do stake your Cardano, you should definitely stake with me at ticker symbol MAX1 or visit stakewithmax.com for more info. Now, some might argue that features like Ledger Live defeat the purpose of using cold storage for your coins, since you want to be able to keep your keys offline for the best possible security. Ledger Live services are convenient, but it's ultimately your call. Apollo seems to be the best possible security option, with the downside of potentially less usability, where Ledger offers great security with more usability. I'll have both linked in the description of this video. Now, the last broad category I'm going to talk about is one that you're probably already using, and these are hot wallets. So you have cold wallets, whose main benefit is basically being air-gapped, a place where you can store your private and highly sensitive crypto information and NFT waifus. But sometimes you want to be able to hold on to some crypto in order to seize on opportunities, like buying up Bitcoin next time it goes through some kind of crazy flash crash. That's where hot wallets can give you an advantage. Normally hosted by exchanges, software-based storage keeps your crypto in always-on secure cloud locations. The potential downside is that you have to trust the exchange. Even the most well-established exchanges like Coinbase, Binance, and Kraken, and KuCoin come with the risk of being exploited. It's for this reason that I personally use cold storage in conjunction with hot wallets, sort of like how you might have both a checking account and a savings account at your bank. So in summary here, there's of course always an option to get a wallet with one of the trusted exchanges. And in fact, most investors can get away just fine doing that if you're brand new or maybe you don't have very much in crypto. They're pretty convenient and secure as long as you have two-factor authentication on. But once you build up a big stack of crypto, or you venture into DeFi buying smaller coins that aren't listed on big exchanges, you start to expose yourself to risk by keeping all your coins in one place. And it doesn't matter how big or how famous the exchange is. The best way to manage your crypto assets is to keep your savings in one or more cold wallets and then keep some fun money tucked away for trading in your digital wallet for transactions. And as always, remember that losing your crypto keys is like losing your virginity. Once it's gone, it's gone.
What's all gone?
The money in your account. Poof.
Now, before I let you go, I need to give you a quick hot offer. The first is BlockFi. They're a sponsor of mine and they let me promote however I like, and they allow you to earn interest on your crypto, whether that's stablecoins, Bitcoin, Ethereum, you name it. And they also have a crypto credit card that allows you to get cash back in Bitcoin. If you make an account with them, you get up to $250 in completely free Bitcoin. That's linked in the description below. And also, I have a Patreon community that you absolutely need to check out. There you'll find all of my buy and sell alerts for cryptos and stocks, much more content, and an amazing investor community, and so much more. I literally spend tens of thousands of dollars every month on my Patreon community to provide the most value possible. That will also be linked in the description. So that's going to do it. I'd like to thank you so much for watching, and I hope you have a profitable day.